Hello everybody, welcome to another phitrends video where along with DubaiNews.tv we bring you an interesting subject matter related to investments. I thought that this could be of interest to all of you because what it does is that it tells you the 6 common mistakes that we do while doing investments or trading in the stock market. I have done these mistakes in the last 26 years, one form or the other, and I'm sure there could be many more mistakes as well that you potentially could do, but it could be a good starting point for you to avoid and look at these parts before you start trading more and more in the stock market. First of all, today we'll take the first point, which I believe all of us are affected with, which is the emotions. I think all of us are human beings. We have a certain emotion. We might like or dislike a certain thing. There are stocks many times you will buy because you read something in the media, you hear from your friends or families or peer pressure, and without analyzing, because there is so much of a media hype, you might go into buying that particular stock or stocks. And that's where usually the problem happens, because you are investing into something which you may or may not know about or may not like about. You're buying it because you might like a brand and you don't know how the actual performance of that brand is, but you certainly like it, you use it every day, which many times could make you money as well. But all I'm trying to say is that while we're using our emotions by hearsay or from the media or from friends and families, it would be nice for us to analyze the information actually before we go in and do buy the stock. I think the second point that I would like to discuss is many times when the things are going good, we forget to sell. We think the good times are going to last forever. Everything is hunky-dory, everything is good, but we forget to sell. That's very important that all of us, while we're doing an investment, we should have a certain return in mind. And once you reach that return, I would really suggest that you should certainly sell. But in case you believe the story is not ended yet, but your return you have reached already, it would be nice for you to sell at least enough for you to get back your capital, while the return could still remain invested, and if there is an upside still going on, you could still benefit from it. So please do remember to sell. Have a certain point in your mind, you decide this much return I want 10%, 20%, 30%, 100%, whatever that number is, but be ready to sell once you reach that point. The third problem that most of us have as a human being is the greed. Usually we all start as a very conservative investors, but what happens is that when we start making a few investments and start making big returns, the greed starts setting in, and we want to have more and more returns. There's nothing wrong with having more returns, to be frank with you. We would love to have that, but while doing that, we many times forget to look at the risk factors or the amount of risk that all of us can take depending on our income and other factors. So it is very important to remember the risk factors, go through the risk factors as to the amount of excess return that you're looking for. What does that entail? For example, today, I can give an example like you have many options available. People start trading in options on a certain event happening or not happening. But usually they forget to read between the lines and understand that they could lose potentially all their money while doing those investments. But if you invest the same in an index, you might, in a worst year, in 7-8 years, you might lose in 1 year 40-50% of your investments, but it will never wipe out your capital. This is why another very important factor that impacts all of us, and we need to be wary of that, which is the greed. As long as we understand the risk for the return that we're taking, and we have the capability to take that risk, that's fine, but we need to understand those. The fourth common mistake that many of us do, and I've done that many times, is that using leverage to enhance our returns. When we reach upon a good winning strategy, all of us want to make more, and many times we don't have enough to be able to use that strategy in a big way, and we end up if we believe too much in it, we end up using a lot of leverage to enhance the returns. And in the meantime, if the markets are going well, it's all good stories. But the moment the markets start going down south, it's a double-edged sword. We might not only lose our return and capital, but might also have a margin call to pay up. So all I'm trying to say is that to make investments through leverage to enhance our returns is a very risky way of doing it, and we should always be wary of using almost no leverage, even if any leverage, at the least possible. But that's again one of the common mistakes that all of us do while investing into the stock markets, or any investment strategy for that matter. The fifth common mistake that I have seen happening, and happened to me a few times, is that keep waiting for the entry points. In a short-term investment horizon, entry points could be very important to enhance our returns. But if you are a long-term investor, which I have been talking about, that it's very important to look through investments as a long-term game. If you want to enhance your returns or invest or make money through investments, it is important to focus on the fact that the short-term volatilities will go away in the long term. So it's important to do your analysis, make sure that you're buying the business at the right price, but not necessarily at the lowest price. Because it's very good to say that, I will buy at the lowest price when the stock market's correct, but in that time you might have lost 40-50% of the return of the stock. So all I'm trying to say is that it is not a great idea to time the market. Rather, it's the best way is to have the short-term volatility being taken care of by the long-term investment horizon. You invest into fundamentally good stocks with a good story, with good growth stories and good management teams, and you will always come up with a winner. But try not to time the market. The sixth and the most important factor, apart from emotions, that you need to look at when you're trying to start doing investments, when you're starting up, it's very important to think about having a stop loss as to where you want. So always invest with having a stop loss, so that you know the maximum amount of loss that you are willing to take. It has happened with me many times that I have lost investments because I put a stop loss at 10% or 20%. Stocks go down and then they go up another 30-40%, so I've lost. But I can tell you from experience that in the last 10-15 years I have significantly saved much more money by putting these stop losses than actually trading with no stop losses. So it's important that you choose not only quality stocks, but when you buy them, you decide what is the right risk factor for you. Once you've decided and what's the right return and risk factors, it is important for you to not to forget to sell on the top and to have a stop loss, so that you know the maximum amount of loss that you potentially could take from this particular investment. If you think you can add value to the life of people through your knowledge and experience, we would request you to send over a video or a podcast detailing your experience and learnings, and we would share it among our community. Please remember our email ID, hello@phitrends.com, for you to send over your information.